Let's bring in RBC's Gerard Cassidy. He is one of Institutional Investors' top-rated bank analysts. Gerard, it's always great to speak with you.
Thank you, Melissa.
What is your take on what has come out, and can you connect the dots to the after-hours actions that we're seeing specifically? For instance, Goldman Sachs is down 2.5%. Citigroup, let me get that straight. Citigroup is up by 1.25%. JP Morgan's basically flat.
Sure. I think what we saw today was some definitive numbers on the stress capital buffers. Now, as you know, the stress capital buffers is factored into the capital ratios for these banks. And all of the banks, with the exception of Goldman, which is why Goldman's trading down, their capital ratios that they submitted at the beginning of this testing period, which are fourth quarter 2019, those capital ratios exceeded the required capital ratios, with the exception, again, of Goldman. Now, granted, Goldman missed it by 0.1%. I don't think it's that big of a deal. They could manage their assets to lower that ratio to get it in line. But what's important here is that the banks, once again, and one of the fellows mentioned it already, they've been going through the stress test now for over 10 years. The banks are very strong. They got strong balance sheets and plenty of liquidity. The uncertainty, though, comes in with these new scenarios with the COVID-19, the sensitivity analysis. The banks are going to have to resubmit the stress test under much tougher conditions, and that's where some vulnerability could come on the dividends later this year.
Gerard, it's Karen. Let me ask you a question. I'm more focusing on the provision for loan losses. So what are you expecting to see from the banks relative to the very large provisions they took last quarter?
You put your thumb on it, Karen. Because of the new accounting, the CECL, as it's referred to, current expected credit losses, the bank had to front load their loss expectations earlier in the cycle. And in the first quarter, the number was dramatic. I think the industry, the number was $35 billion. That provisions, I'm sorry, that was for the top 20 banks, $35 billion. For the industry, it was over $50 billion. So I expect for the top 20 banks, we're going to see provisions at least equal to what we saw in the first quarter, because the bank have a much better handle on the severity of this downturn today versus what happened in March and April. Now, once again, the banks are well capitalized. So unlike 0809, where they not only lost an enormous amount of money, they also had to recapitalize themselves. We don't expect that to happen. This is an earnings issue. They'll get through this, but that's also assuming we're going to have a recovery in the second half of this year.
Given the banks have to resubmit their capital plans, Gerard, I'm wondering what you think of the bank trade for the remainder of this year. Is this a year that you have to simply look through because of this uncertainty of the COVID overlay that the banks are going to have to go through?
I think, Melissa, initially that is the trade. It's really who's going to come out of the credit cycle that Karen asked about. That's going to be the real trade initially. Does Bank of America or does a JP Morgan surprise on the upside in the third or fourth quarters with provisions that are lower than expected? So I think between now and the end of the year, it's purely a credit trade. But then when we get into 21, it's going to be more of a macro trade in the sense that where do interest rates go and where does the consolidation of the industry go in view of what we're experiencing today.
Gerard, always great to speak with you. Thank you for your time.
You're welcome.
Gerard Cassidy of RBC. If I were a conspiracy theorist guy or a skeptic, both of which I am, basically, and you are too, all of you are, I would think that the Fed is making this sort of point-by-point call on dividends and buybacks because the uncertainty surrounding the economy is so great, and that would be negative for the markets.
Well, yeah, I 100% agree. I couldn't agree more. And just go back to Wells Fargo's first quarter in the middle of, I think it was the middle of May. I mean, they took their loan loss provision was $13.8 billion. That was up 413% year over year. They're telling you what you want to know, that, you know what, they're concerned. Now, maybe it won't come to fruition, but clearly they're seeing what lies ahead. So it's not about the banks. The banks aren't the problem this time. It's the other end of this thing and what the consumer looks like when we get through it. And we will get through it. It's just a question of the timing. So, again, I think the banks are telling you all you need to know. Everybody seems to magically think we're going to be back where we were. I don't think that's happening, and I think that's really scary for the market going forward. But I've thought that for a while now.
Tim, you disagree?
Well, I just think that this is all about a Fed that suddenly has a mandate that is out of control. Okay, so what is different today about safeguarding against things that might happen on the banks out 2, 3 months, 6 months, 2 years, because we know that we're in we're in uncharted grounds, than buying fallen angels in the high yield or junk markets, or backstopping corporate debt, or nationalizing every other part of the economy. I mean, this is out of control, but it's no different than the Fed that we've heard from for the last 2 years. So as much as the skeptics and the conspiracy-minded people that we all may or may not be, I don't think this is fresh bad news. I think this is totally in vein and in character with the Federal Reserve that's doing this in every turn. And it's a problem in the big picture of our democracy and our, essentially in capitalism, I should say. Forget democracy. That's got its own issues. But that's the Fed I'm worried about. Capitalism is dead. And this Fed is no different on banks than they are in every other part of the economy.
Right. The price discovery that has been squelched because of the Fed's action, the zombification potentially of certain parts of the economy, that's all bad news, Karen. But here for this bank trade, with the Fed that is taking extraordinary measures, you also have the Fed that is injecting liquidity to the point where you know the banks won't fail.
Yeah, I think the Fed has been a tremendous friend to the banks, right? Think about the crisis started and all these banks had revolvers that companies were drawing down, hundreds of billions of dollars of revolvers. And when the Fed said, we're going to be there in the corporate credit market, not only did those revolvers start to decline materially, but instead the JP Morgan Capital Markets desk got to help them issue a bunch of debt to replace their revolver and get paid a fee on it. And that was because of the Fed. So the Fed has done an enormous favor to the banks that they asked them to maybe go slow on their capital plan for the rest of the year. To me, that's very reasonable. I don't think they should be upset with that. The Fed has been their friend.